either. It has been pointed out, guys like Jim Paulson, and I heard from other people, that a lot of times during a period of rising interest rates, stocks do well, at least back to 3% as the normalized level that you saw, because when rates are headed up, a lot of times it means there's some good economic activity. So it's not necessarily a negative, even though you think that we're in a danger zone for fixed income. It's not necessarily a bad thing for stocks, but I guess it's the pace, once again, that we're talking about.
The pace, the reason, and the part of the market as well. So it can be a good thing for your more cyclical parts of the market. And I think one of the points we make is we're coming into this year with a much better outlook, but with stretched valuations. So returns this year are really going to come from the change in earnings. And it's really the cyclical parts of the market that will see the biggest delta in earnings this year versus last year. Those are the kind of sectors that can absorb rising yields, that can really tap into this improvement in the economy. So just an example, financials will see a 40 percentage point change in earnings. Consumer discretionary, 70 percentage points. If we look at healthcare, only 2 percentage points. Tech, only 10%. So that's the reason why these rising bond yields related to rising growth benefits these more cyclical parts of the market. And we continue to expect that to happen. Is by no means done just because it's been happening for a few weeks here.
Can you pick out winners and losers in tech? Will the reopening tech stocks outperform the ones that did so well last year based on flourishing during the pandemic?
Yeah, absolutely. And I think one of the big themes for this year is broadening out of the recovery, speaking of the economy and the market. And within tech, if we remember last year, it wasn't tech broadly that did well. It was really just the largest mega cap tech stocks. So for this year, if we want to play the tech theme, we do have to broaden out the tech exposure. And remembering that tech is a lot more than just those large companies. Tech can encompass themes like digital payments. It can encompass cyclical parts like semiconductors. So it's a much broader theme than just the largest companies. And that's why we're seeing the biggest pain in your FANG plus type of companies, because they were the very specific part within the market, within tech, that did well, and that now is readjusting their valuations as a broader rotation takes place. And we don't think that's quite done yet.
Does the Washington backdrop, whether it's the latest stimulus bill or the possibility of a large infrastructure bill, does any of that, are you assuming any of those things, or you just don't even try to figure that out in D.C.?
I think we can pretty safely assume something about the current rescue plan. So we do think, by the end of this week, we'll have something passed close to that $1.9 trillion. And one important thing to note about that is that a lot of that fiscal aid is very front loaded. And we estimate that about $1.2 trillion is going to feed through just in the next 7 months. So that's a lot of fiscal support for the economy just in the next 7 months. On top of what we expect to be a surge in vaccinations, where we can potentially reach a herd immunity threshold over the next 90 days, and combined with an economy that's actually entering this year much more resilient than we expected. So we had a good idea, a good estimate for growth this year, but we've only gotten positive surprises, and we think the risk is tilted to the upside. And that is why you're seeing such a violent reaction in bond yields and in this rotation towards cyclicals as well.
Shepard Smith here. Thanks for watching CNBC on YouTube.